All right. So why don't we just let's take kind of where we are today, I guess, and maybe touch on those two areas you just brought up. So in terms of some cyclical names having a fairly significant bounce, and now that we're seeing maybe a correction of some of these growth names, do you see this persisting, or do you see this an opportunity to go back into cyclical name, or how to look at it from that perspective in terms of some of the value names, some of the cyclical names, and some of the more pure growth names, given what we're seeing now?
Well, after Tesla and Apple split, and then Tesla the same day or the next day announced that they were going to do a $5 billion secondary, that pretty much did the starch out of the rally. And it was that same day when actually Ciena reported that orders were going to be light, despite better than expected earnings for the quarter, and they guided down for the rest of the year. So that negative sentiment has put in a pretty good correction in the broad indices, and led by mega cap tech and many of the high flyers, we see some rotation going on here. And we expect that's going to continue, but it's going to run its course over the coming weeks, provided we don't see further shocks on the political or the trade front.
Right.
In fact, after reducing by 2/3 or more our Ciena position near the highs, we recently started nibbling to replace the sold shares. So anybody that was able to trim some of those high flyers at the top now have an opportunity to buy stuff 20% lower.
So are you seeing this action now as more of a profit taking, or the beginning of a larger correction, or what are your thoughts in terms of how you're seeing some of the stocks behave?
Well, I mean, it was definitely ready for correction. People were pretty surprised it was going up every day in August, and they were just like, I'm glad I'm at the beach. But earlier in the year, we also saw other growth names like Starbucks and Nike, which have been recovering with the Chinese economy, as well as more cyclical stocks like Intel and stuff that are still a lot lower. So we think that there's plenty of companies that meet our criteria and that are strong candidates for continued gains, where we can put money to work in this market, even as the rotation continues.
All right. Interesting. Why don't we I'd love to just drill a little bit deeper into some of these growth names or some of the evaluation differences with regards to your methodology. So when you look at some of these names, like you mentioned a few, a Ciena or a Microsoft, which on face of it still seem like they might be expensive. And of course, we have a different subset of names that are even more expensive in terms of Zooms and Tesla and Shopify. Maybe give us an idea of how you sort of look at the valuation, or how you would say that Microsoft is still a good value, or Ciena is still a good value, given her global payments might still be a good value, even though they're expensive. How do you have to look at that in the context of the overall market today, with valuations being spread so much across a lot of these names?
Well, remember that the market is still looking at earnings in 2022 as baseline. They're not looking at 20 earnings, and some have already reported, fourth quarter 2020 earnings, and they're going to start next quarter with 2021 Q1. So a lot of estimates you have to look at in 2022, and if you're looking at Microsoft in 2022 at 27 times, that's up from 18 times 2 years ago, but interest rates were at 3%, and now they're at 1 or 0, and Microsoft's still going to report 11 or double-digit top-line revenue growth the next couple of years, and they own the cloud space, so not just in the U.S. but all over the world, they are the cloud computing hoster of choice, and we think that's worth a discount to the market multiple, which is where it's trading.
Right.
Because the stuff like you're talking about, that other stuff's trading at 50 or 100 times earnings, and in many cases it's trading at 25 times sales or more, and it's going to take forever for them to grow into those multiples.
Right. It feels like we have some shades in 1999 potentially with some of these relative valuations where everything looks relatively well priced against 35 times sales for Zoom or Shopify.
Well, it's not just there. It's also in any consumer name. So you look at, we like a company called Elanco. It's an animal healthcare stock we just bought near the lows, last quarter, and shares were trading at steep discounts to the normal multiple, but in a great business where they were closing their deal to purchase Bayer's animal health business, which is a global business, not just companion animals, but also farm animals, equine, and everything else. Mm-hmm. If you look at their senior management team, they're all rapidly snapping up shares, doing insider buys, whereas Chewy, which is usually named as the hot stock around town, it's got double the market cap. Their CEO and their CFO have been selling shares hand over fist. I think Singh just sold $4.5 million in stock, and the CFO just sold maybe half as much. But they just IPO'd a year ago, and the company's got significant growth challenges. And I look at Elanco. They've got 35% revenue growth. That's nothing to sneeze at, and they're trading at 21 times fiscal 22 years, and they only 13 times cash flow. So, I mean, those are real numbers for a real business. It's a global business. It's been around for a long time, and I have a higher degree of confidence in owning them than Chewy. Unless, of course, you just saw the earnings. Did you just see the earnings go past the tape? They were supposed to have a big. So I'm turned away from that. There were pretty high expectations for Chewy's earnings. It still would have been a sale on the